Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. Overall, the market continues to move in the general direction, moving up and away from the congestion zone previously highlighted, made up of the lesser Fibonacci lines at 1400, 1389 and 1378, though the last week and a half has been a roughly sideways action. Anyway, these three lesser Fibonacci lines, 1400, 1389 and 1378, had halted falls since late July and actually held up the market in August and September, the start of October, and most recently the end of October. I saw this as an ammunition gathering exercise for the move higher. Additionally, we have the results of a larger processing operation, the July to late October descending triangle, which I've highlighted in dark blue on my daily chart. The upper trend line used was now the defunct mid-August to date downtrend, backed up a little higher for most of the time by what was at the time a paralleling and declining medium moving average, currently 1437. Meanwhile, below those same levels of 1400, 1389 and 1378 that acted as the base of the triangle. At the end of November and going into December, prices punched up and over the 50% Fibonacci line in December 2020 to February 2022 move at 1451, whilst utilizing the base of the median moving average to do it. The potentials on the upside from the descending triangle, as I said 6 weeks ago, and I quote, "So taking all that into account, a primary target X would be in the 1545 area, and a secondary and much harder to reach target X1 would be in the 1605 area." I also added something at the time which has turned out to be very prescient, and I quote, "So what have we topside that might get in the way?" Well, to be honest, not much, which is why I am a little surprised and concerned that prices have not moved higher than they have. You see, we have highs in September at 1493 and 1508, but the next clear resistance topside is in the band between 1521 and 1534, containing the flatlining long moving average. The long moving average is now actually dipping lower and is currently at 1512. And I added also the 50% Fibonacci line for 2022 at 1532. End of quote. Well, prices eased up over the lesser Fibonacci line of 1478, and by the earlier highs, we ought to have seen a free rise higher towards the 2014 highs at 1522. However, four new factors have now started and have entered the frame. Firstly, we have the April 2022 to date downtrend, currently at 1505. Secondly, there is the long moving average, which is arching lower and starting to parallel the previously mentioned downtrend. Thirdly, there is a possible new pattern, a bull channel from mid-November and highlighted in purple on my daily chart, and that's currently 1461 to 1514. This is a nascent bullish pattern, and whilst it looks good, I'm not happy about the sideways movement we've seen the past week and a half. The lower bull channel line may need to be finessed or even the whole pattern retired if we continue sideways. Finally, there is the golden cross formed yesterday of the rising short medium moving average, currently 1438, moving up over the slowly rising medium moving average. Please note, though this is a bullish indicator, it is a lagging indicator. Chicago soybean meal. We have had here and have here still for months now different patterns, not so much melding with each other, but rather crashing in and out of each other. The most recent here has been the weekly key reversal up seen 3 weeks ago. But it's not the main pattern here. The main pattern continues to be the May to date seemingly broken, then repaired, ascending, expanding wedge pattern, something I pointed out many months ago. This has developed. It's currently 412.20 to up off the top of my daily chart so far that it doesn't really matter now. It is not a perfect pattern by any means, and to assist in seeing this pattern I've highlighted it in dark blue. The recent weekly key reversal up managed to mend the many and varied breaches and breaks of the lower trend line, currently at 412.20. That lower trend line is also the neckline of the huge November 2012 to June 2022 head and shoulders continuation pattern. This second earlier pattern had been the signature pattern here since last year, and you can see how it still resonates even as recently as last month. The move higher from the weekly key reversal up punched through some interesting levels and filled a significant gap. Prices went through the early and late August highs, the two September highs of 444.80 and 443.80. Then filled in the changeover gap from August, which stretched up to 455.60. After that, the August high at 468.10, which didn't really slow the market down at all, until prices finally peaked 2 weeks ago at the combination of the 2021 high at 471.40 and the neckline, currently 470.90, from where the subsequent drop started since the start of last week. And that's with a distinct combined bearish engulfing pattern and bearish opening long black Mariposa. The move lower since then has been in a staggered way. Interestingly, on each of the last 2 Tuesdays, we've had combined bullish harami and inverted hammer patterns. It would be interesting to see if we have one this coming Tuesday, the 27th, so keep an eye out for that one. Overall, looking at the action since mid-September, the market has formed an irregular even-eve double bottom, with the recent move higher being the result. What we are seeing now is the pullback down, and I am wondering now 2 things. How far will this pullback down go, and what will be the next pattern? I suggest the pullback down may be limited by these possible levels. The September highs at 444.80 and 443.80. The April 2021 high at 439.30, and my personal favorite, but it requires a significant move lower, is the combination of the end of October high at 430.10 and the long moving average, wherever that may be at the time, and that's currently at 426.80. The October high is the cleft in the double bottom. As for the pattern, well, that is still an open question, as none is suggested since the double bottom was formed and exploited. Chicago soybean oil. Slightly less lines than last time. I've retired and taken some away, but also I've added some others. There nevertheless have been a lot of things going on here. The key recent features have been feature 1, the bow tie formation in late October that showed the initial bullish nature of the market at the crossover of the moving averages, and I suppose showed the subsequent bearish nature that the market turned into during the week of the 15th to the 22nd of November when it comes to fruition. The more recent factors have been feature 2, the lower time currently at 60.21 of the December 2021 to June 2022 bullish shift pitchfork, which I have highlighted in bright red. This lower time, along with feature 3, the April 2020 to date uptrend, currently also at 16.21, halted the decline early last week with a combined key reversal up and bullish double, and started a subsequent move higher. Now, these two didn't do such a thing on their own. No. They had help, as just below them last week and still down there now is a whole series of other supportive features, including the 2011 high at 61 even, the supports at 59.44, then at 58.82 to 58.16, which inside has the August 2011 high at 58.59, plus the September 2012 high at 57.64. This all caused the market to revert back up and in the process form an interesting small ascending wedge pattern over the last 3 weeks, which I've highlighted in bright green, and that's currently 63.62 to 65.88. This pattern is pretty much developed, but as yet has not broken out. So I can't give you any targets, above or below. However, I can give you an idea of the potential size of the moves, higher or lower, when they happen. A confirmed break higher would see a primary target about 2.9 cents on top of the break, with a secondary target about 4.6 cents on top of the confirmed break. A confirmed break low would see a primary target about 1.5 cents below the break, and a secondary harder to reach target about 4.6 below the confirmed break. I would add 2 cautions to this idea, especially on any confirmed break lower. Firstly, such patterns break lower nearly 8 out of 10 times. This is not a directional indication, just a statistic, a stat. Secondly, if we do break lower, watch out, as this ascending wedge pattern may end up being the hesitation in a halfway hesitation pattern. And that would have potential down to the mid 50 cents level should it choose that route. We should have an idea which way hopefully by the end of next week, or else we may likely have a new and completely different pattern. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.